Right.
I didn't chase. I mean, this is no dig on the dog, but I didn't chase them down for their monster.
Uh-oh, dog. Come on,
I'm just
dog.
throwing anybody
Listen,
out.
I knew I shouldn't have tweeted about that company, man. But I was like, listen, the
You're
people
catching the
got to
heat
know
for that
about
one,
this.
bro.
Hi, and welcome to the Investing on a 9 to 5 podcast. I'm Paul.
And I'm Teddie. We are excited that you are joining our show, Investing on a 9 to 5, where we will talk about our investment journey, our current strategies, and learn about all kinds of investing related topics. But before we dive in, we are not financial advisors. We will not be held liable for any personal investing decisions or losses that you may occur in the market. This page is purely for entertainment purposes only. Welcome back to the Investing on a 9 to 5 podcast. It is your boy, the Dividend Dog. We have Paul, options underscore legacy. And on today's Sunday Fun Day episode, we have our special guest, Nick. Nick is a dividend investor just like myself and Paul. We all associate ourselves on Twitter. We found each other all of us on Twitter. Nick is in some of the same companies that Paul and I talk to. We do, basically some of the same strategies. We're going to have him on the podcast this morning just to talk about his journey, basically like his portfolio, basically his lifestyle, just so our viewers and listeners can get to know Nick. Nick's a very cool guy. Got to know
history
him.
Of this guy.
Yeah, I got to know him. Basically, he's almost like my brother, coworker now. I talk to him every single day. Talk to Paul every single day. So Nick's a great guy, and I'm gonna hand the mic over to him, and then he'll go over his background. Then we'll jump over into our topic today on three main metrics that we all use as far as like when we look at dividend investing and dividend stocks that you guys could take a part of. Nick, the floor is yours.
All right, man. Well, thank you guys. I want to say good morning to both of you gentlemen, and thank you so much for inviting me on. I'm truly humbled by the invite, and I'm ecstatic to be here. I'm delighted to be here. So it's going to be a great talk, and I hope your audience and your listeners they gain some kind of knowledge from the three of us today together. All right, so I'm just gonna kind of like start by saying, Dog and Paul, we're no strangers to each other. We've been communicating for a few months now on Twitter, and I haven't been on social media too long. I just kind of started, and I've just been welcomed with open arms from all you guys. So my gratitude to all you sincerely. You guys have made this experience fantastic for me, and it's been great to communicate with everybody, and just to bounce off ideas. Dog, especially you're my guy, man. You know that.
Yeah, man. We're at it every single day, man.
Yeah, man. You always show up and you're always there, and I always feel confident that you got my back if I need something to bounce off of, or
same here with me. When I see you tweet on something or respond to my things, I'm like, yes.
You know what I mean?
I got some backup here. There we go.
Yeah, man. That's how I feel about you guys too. I always look for your content. Both of you guys. You guys are sound investors, and you're gentlemen. So, truly, truly honored to be here, and I really look forward to talking to you guys.
Awesome.
All right, so let's go into some background. I'm going to give you guys a little bit of a glimpse into my background and kind of how I got to this point. So, all right, so let's go through it. I was born and raised in Yonkers, New York. I'm 35 years old. And, all my childhood and everything, I came from a middle-class family. We didn't come from the greatest neighborhood, but we grew up in a middle-class neighborhood, a middle-class family, and pretty much everything was middle-class, And like I said, I grew up in Yonkers, New York, which is the first big city outside of New York City. So just a little bit north of New York City, about half hour. And that's where I grew up. So let me go a little bit into my childhood and my upbringing a little bit, just to give you guys a little bit of background. So as a kid, I was very good with saving my money. And that came from my father. My father was the biggest influence of my life. He was everything to me. And, he played a huge, huge role in every step of my life. So he was always in my ear saying to, save your money, save your money. So he really nailed that home for me and my sister since we were young kids. So, I put that as a priority in my life, even as, in my teenage years and in my 20s. So as a kid, I felt like I had two skills that kind of separated me from the average normal kid growing up in Yonkers, just like me. And that was, number one, I had the knowledge and I had the priority to save money because I knew how important it was, because I always had my father in my ear. And then also, I always had the willingness to work because, like I said, my father was my role model, and he was a worker, man. I mean, the guy was a grinder. He took every opportunity to make a buck. So he really, he was really a great role model for me, and that's how I was. I always had that willingness to work, and it was anything. Like when I was a kid, I did 1,000,001 things. I remember being 14 years old and working at where he worked at the time. I was making boxes in a warehouse in the summer, and it was hot in there. And I was so willing to make a buck. And I did so many things. Like I said, I worked at CVS. I worked at delis. I delivered auto parts for like 3-4 years. I was a security guard while I went through college, so I could do my studies while I worked. So all my life, from I'd say 16 to being an adult until I got my career, I always worked hard and I always worked full time. I remember being 19 years old and I was working full time, going to college full time, and going to the gym full time. So I was busy, man, and I was always.
Yeah, sounds like it, man.
Dude, it was crazy back then, dude, and that went on for years. And I was always willing to put in the work because I wanted the money. To be honest, bro, like I kind of had this fear, to be honest, and I guess it was from him, that I never wanted to be broke. I never wanted to feel that struggle. And I always felt like I needed to pad myself and give myself a little bit of a cushion. And I was a kid, man. I'm thinking like this at 16, 17 years old. And, my dad was, I guess you could say, borderline cheap, but he was frugal for sure. He was frugal for sure, but everything that he put on display for me and my sister, it was towards the positive. Like we didn't go on a lot of lavish vacations. We were kids. We didn't have the nicest furniture in the house, things like that. But he was able to pay for myself and my sister to go to college cash. So
there you go.
He always he did right by me, man. He was my saving grace, and he was my driving force. Absolutely. So all right, so let's kind of fast forward to 2016.
No, that's awesome, man.
It is awesome because
2016 was kind of a turning point for me, the first turning point in my life, because that's when I stepped into my career. I'm a physical education teacher by trade, by day. So, I went through college and I got my master's and all that stuff. And, 2016, I landed my career. So still, at this point, I still know nothing about investing. I have no inclination, no knowledge about investing. I know how to save money. So I've just been stacking money from like 13 to like, at this point, I'm like 27, 28. I'm just stacking money. So I got a whole bunch of money in the bank, sitting in a checking account. I know people on Twitter would kill me for that, but sitting in the checking account, not doing anything, not going to work, not accumulating anything, just sitting there. So I'm about 28 years old at this time. And what I do was I kind of implement what I knew as a kid, my abilities to save money and my willingness to be a grinder and to work. I implemented that now into being an adult and having a career. So what I did was, at the time, this was 2016, I just found more ways to make money. So typically a teacher, especially in this area, when they finally get their teaching job, that's it. They ride that and they're happy. They work there, 7:30 to 3 o'clock, and they're drained by the end of the day dealing with the kids, and they're happy with that and they're done. But that wasn't the case for me. I always wanted more. I always worked 2-3 jobs at a time. Right. So what I did was I just kept looking for the opportunities. I kept looking. And at the time, what I was doing was I was teaching phys ed during the day, and then I would teach adult education at night to the people that were coming to this country and they were eager to learn English language skills. I was teaching them English language skills. So nice. I would work during the day. Okay. And I would teach at night as well. And that's what I did. I was just always looking for the opportunities. And I was still doing the same thing because I didn't know much about investing. I had no idea. So I was still doing the same thing. I was making decent money now because I had my career plus my side hustle. And I would just stack money. That's what I would do. I would just put it away. I was still living in my father's house. I was living in the bottom apartment. We had 3 floors on our house, and I was paying him a little rent. But I was really still living under his roof. And he held me down. He said, you can stay here as long as you want. I don't want you to leave. We were a very tight knit family, So he said,
Yeah, that's awesome, man.
you know what I mean? So he said, you can
Yeah.
stay as long as you want. Just do me a favor. Just make sure you save your money. So, you know, I held up that end of the deal, and that's what I did. I just kept stacking. And, you know, at this point, I'm probably making, at my teaching job, I'm probably making about 75 and then another 20 at night. So, you know, I'm making decent money and I'm just stacking, bro, just stacking. So,
Yep.
and I did that. I did
Man.
that for years, man. And that was like the natural occurring thing for me, you know?
Mm-hmm.
And what's funny is that, talking about my father, he was doing the same thing. He was a teacher as well. He was the teacher at the high school level, so he taught during the day, and then he would work the adult ed program at night too. So I was kind of following in his footsteps, just
Skip
kind
off
of
the old block, man.
Right.
Yeah, man, just kind of doing it, you know.
That's
So
awesome.
I kept going with that, you know. 2016, 2017, I'm grinding, I'm going. So then let's go to 2018. That's where, bro, that's where my life took the biggest turn ever. And that's where the biggest turning point in my life was. So 2018, we're going to go to September 2018. No, actually September 2017, because it goes into the next year, January. So 2017, September, my father got diagnosed with liver cancer. So that was a huge blow for me, man. I mean, like I just told you.
Sorry to hear about that, man. Yeah.
He was my hero, man. He was my everything.
Yeah.
This was abrupt, bro. Like this was, you know, this was not something that we were anticipating. So, you know, he started the treatment and we got some positivity from the doctors saying that, hey, if we can control this, we're good. You know, he can ride this out for a long, long time and everything should be fine. So as we went through the school year that year, we're both doing the same thing. We're working day and night. You know, eventually he stepped away from the night work because it was a little too much with the chemo and everything and all the things that he was doing. So, you know, and then fast forward that summer, 2018, it was August at this time. And what happened was he ended up developing some kind of infection. And, you know, it put him in the hospital. And because his liver was so weak, he couldn't filter out the infection and he ended up passing away. So,
sorry to hear that.
Thanks, man. Thanks, Paul. So this was August 2018, and this was tough because we weren't ready for this. Me, my mother, and my sister, we were not ready for this. He was our leader, you know. He was a leader of our family in so many ways, and we looked to him. And you know, I wasn't ready for it. My sister wasn't ready for it. My mother, forget it. She was nowhere near ready for it. So you know, at this point, we were scrambling, bro. We didn't know what to do. So, you know, our family at that point, we kind of made some decisions. My sister and my mother, they moved down to North Carolina, and that was a better life for them because my sister has a kid, and you know, Yonkers, New York, is not a place to raise a child, honestly. And he was growing up on the same street that I grew up on in our family house, and you know, the neighborhood changed over the years, and it was not good. And you know, they made the right decision, but then I'm left still in New York, and I got my career here, but I can't afford to live in New York by myself. So at this point, I had to make a decision too, and I ended up relocating about an hour up to Connecticut, right on the border of New York and Connecticut, because it was more affordable. You know, and the property taxes and you know all everything else as far as living expenses, it was much more affordable than New York. So you know, I made the move. And still at this point, I have no idea about investing. I have nothing. But my saving grace was that I was such a good saver as a kid that I had a little nest egg. I had about $60,000 in the bank, and then combine that, right? I was lucky, man. I didn't do anything with the money. I was frugal as a kid, and I had this money, and you know, combine that with now the little bit of money that my father left me, my sister, and my mother, and combine that together. Now, automatically, I have over $100,000 to work with, and you know, I was extremely blessed, and I was in a fantastic position. So you know, I had a moment with myself, and it wasn't the brightest moment in my life. It was not good at that time. I was not in a good headspace. And I was struggling, man, to be honest. I was struggling at work. I was struggling teaching. My mind was just not there because of this loss of my father. I was really having a hard time with it. And just by, you know, being with myself, and I'm away from my family. I'm away from my friends now. I'm by myself in Connecticut. I had a moment with myself and I said, listen, I said, you have an opportunity here. You just went through the hardest thing in your life and you have an opportunity. So what I did was I made a commitment to myself right there. It was September, October 2018, right after he died. I said, I'm going to make something of this. I'm going to make something of myself. And what I did was I just deep dove into learning about how to grow my money and building wealth. I deep dove and I learned about everything, bro. And what I did was I would work day and night. And then the days that I wasn't working at night, I would get myself up here, I'd get my butt up here, and then I would just plant myself here every weekend and I would just educate myself, bro. I would read articles, I would read books, I would listen to podcasts, I would watch YouTube videos, and I was getting a good scope on how this worked, you know, and I was learning about retirement funds and how to grow my money and, you know, mix them with, you know, tax advantage and tax shelters accounts. And I learned about everything. And the one thing that fit my life beautifully because of my go lifestyle, because I'm, you know, I got the hour commute back and forth and I'm working day and night. The thing that fit my identity at the time was dividend investing.
Woo!
Yes, sir. Doggy dog. Let's go.
Ding, 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 ding.
It was. Bang, bang. So what did I do? I doubled down, bro. And, you know, at the time, Fidelity was still with commissions on their trading. We weren't there at as far as commission free. So what I was doing is, as I was learning, I was throwing big chunks into my portfolio, bro. I was throwing big chunks. So the more I learned, the more I would throw money in. The more I learn, the more I'm throwing money in. And now combine that with, in the background, now I'm learning about investing. I'm getting some superpowers. In the background, you know what I mean? In the background, I'm still doing what I've always done, working 2-3 jobs, working day and night, always looking for opportunities. And what I did was, at the time, I didn't slow down, dude. What I did was I looked for more and I was driving myself nuts. My lady wasn't happy with me, but I wanted more. So I would go to like the athletic department. Hey, you got any coaching after school? Oh, I can coach the boys basketball team after school? I'll do it. Oh, you want me to run a program for the girls volleyball? I'll do it. So dude, I was working phys ed, coaching in between my 2 jobs, and then working at night. And then getting home at 10 o'clock, going to bed and doing it again the next day. So dude, I did that for years. I've been doing that for years. And just recently, we're talking like 2 weeks ago, because of the moves that I've made in social media now and kind of my vision of where I want to go to the next level, as far as, you know, me providing content to my audience, I've been able to step away from the adult ed at night. And this was very recent. This was 2 weeks ago.
I think I saw you tweet about that.
Yeah, man. So, you know, I worked the night program for 11 years. I even worked it before I did the phys ed work. So it's been hard to get to this point, dude. Like, you know, yes, I've been helped in some ways with some funds from my father and everything like that, but let's not kid ourselves. I busted my behind as a young man for all those years, and I was able to set myself up. So to get to this point it's been fulfilling, man. I mean, I never imagined I'd be able to build what I've built so far. You know, I've been able to grow my portfolio to close to $13,000 a year in dividend income.
Saw that.
It's been tough, man. I'm not gonna lie to you. It's been tough, bro. I've been grinding for years and years and years. So, you know, that's kind of my story. That's kind of how it all happened for me. And, you know, it's my perseverance and my dedication to my work and my ability to work that has separated me all these years. So, that's it, man.
Amazing.
That's where we're at now.
Awesome.
It's a great story. And I think one thing that people, and you don't take away from, you know, your accomplishments because of some added income that came in because of an inheritance or whatever, because what we do, and I mean, people in general, is we find that we have money, we spend it. So if you're out there right now and you're struggling to throw $10, $20 a week into a dividend account and it's growing slow, that's the discipline you're building right now. So that eventually, if something happens in your life where you do have this income come in or this windfall come in, you've already established that baseline of discipline to go ahead and put that money away, to not run out and go buy that car, that TV, that other item that you've been looking at. Take that money you've been given, or take a trip, take some lavish honeymoon to the islands. But
listen here.
But I think that goes to that discipline that your dad instilled in you, that you developed over the years of working hard. I know we've all been there. You know, none of us were born into that family where we were just given everything. You know, I know the dog was growing up middle class. I grew up middle class, when I was a little kid, we grew up in a single wide trailer, out in the country of Illinois. So, my family came up middle class from there, but it's all part of that discipline that you develop as a kid and build as an adult through working multiple jobs, putting the money away, making sure your bills get paid, because there's no one back there. There's no trust fund to fall back on. So I think that's
no one's coming to save me.
Nobody's coming.
For us.
Nobody's coming.
One thing I'm curious about, and before we get started with the little 3 items that the dog has set aside, is I was looking at your Twitter, and I remember you posted your portfolio, and I'm curious how you came up to like the 56 stocks. If that's something that are you continuing to add positions, and how do you manage that? Because I know it's tough for me with the long-term holdings I have. I'm watching for news and earnings and tracking dividends, things like that. I know there's lots of programs for that, but how do you kind of manage that? Do you just kind of leave it all on autopilot and look for news events, or do you follow each one closely?
Right. Great question. I get that. I get asked that a lot. So what I did was, when I first started, what helped me a lot was I understood that a lot of the companies that are making these products, they're household names, right? So what I did was, mind you, I didn't have a lot of knowledge at the time, but I kind of put 2 and 2 together. If something is in my house, it's got to be in more than one person's house. So what I went around was, I went around my house and I said, okay, so I want to know who makes this lotion. I want to know who makes this shampoo. I want to know who makes this and this and this. And I made a list. I remember this. I made it in this house right here when I first moved here. I made a list of all these companies, and then I would just deep dive into Coca-Cola. I would deep dive into Pepsi. I would deep dive into Johnson & Johnson, Procter & Gamble, Unilever. And I started to understand. And what I did was, I slowly started building the portfolio. Mind you, at the time, I wasn't familiar. I was familiar with it, but I didn't know exactly how powerful index alone was, right? Mm-hmm. So I always understood that index funds were for your Roth IRA. You leave it there, you add to it, see you later, right? But if you wanted to build active income, you have to buy individual stocks. Not exactly the case, right? But that's what I kind of understood in the beginning. It's kind of warped, but that's what that's the approach that I took. So I just started building it out. And once I learned about a company and I was comfortable with it, I would invest in it. And I always said to myself, once I learned about the CEO and I was comfortable about the CEO, I was okay with jumping in. And that's what I did. So for now, I have 56 stocks. What I do is I purchase, or I make more purchases into more shares when I see if something is undervalued. And to manage it on the daily, I'm not gonna lie to you guys, it's tough, it's hard. Just to be involved in the space, but I will say this in a testament to me. All my life, I've always been obsessed with sports. Sports has been everything for me as far as my hobbies and my interest. So once I started learning about investing, the sports element of my life kind of took a back seat, and it's hard to say, like a phys ed teacher, but and what I did was I don't want to say replaced, but I kind of complemented my hobbies and my interests into dividend investing and dividend stocks. So I found it enjoyable to read about Howard Schultz and Starbucks. I found it enjoyable to read their earnings reports and news about them, and learning about their patterns and their charts and how they move, and what elements of their company moves the stock. And again, like, I just found it enjoyable. So at this point, it's so part of my life and it's so part of my daily routine that it's almost like second nature to me now. So 56 stocks, yes, it's very difficult, but I love this stuff, bro. And this is why I really
love it.
Yeah.
Yeah. Now I want to add more because I want to add my stuff like Nick.
And then to answer your question, Paul, to see what I've been doing for all my years is that I try to limit it to 2 to 3 new positions a year.
Okay.
So, that's kind of been my baseline, and it's worked well for me. So, just to answer your question, I love this stuff.
That's some good discipline too. Because I know I look at I hear about this company and he sees doing, I want to buy that stock. I don't. I'm not. I used to be like that when I first started investing, but now it's hard though to kind of hold back and not buy something just because you heard some good news about it or you think something, but to maintain that discipline like we went through before about this is what I'm going to do. For sure. I made an analogy before about investing from my point of view is I'm a baseball fan. And to me, investing, and especially dividend investing, really goes toward that mindset Baseball is a 162 game season. Every game is important, but every game doesn't necessarily make the season for the team. But the cumulative effect of those games at the end of the season are going to show what that team did. And for me, that's how these companies are. These dividends are. You're going to collect these dividends quarterly, monthly, whatever, and they may be pennies, they may be dimes, but at the end of the season, those dimes have accumulated, and now you're looking at dollars. And a couple of years go by, and those dollars turn into $10s, $100s, and then you get to the point like yourself where you're looking at $12,000, $13,000 a year in additional dividend income, and then that snowball that people talk about just keeps building. So for that 12,000, for that jump from 0 to 12 is tough. The jump from 12 to 15 a little bit tougher. 15 to 20, 20 to 50, and now you're rolling. 50 to 100 comes pretty quick. So you're gonna. I see your goal. I saw your goal the other day, and I know you're gonna make that goal like half the time that it took you to get to where you are now, which is gonna be amazing.
I hope so. Man.
I can't wait to see it.
While we're sitting here, I got my notice from the dividend thing that I got a payment. I got paid today. SRE paid out today.
There you go, my man.
Yeah.
Yeah,
hey man, I really like that analogy. I think I might steal that, Paul. That baseball analogy.
It's free. It's public use. Go use it.
That's kind of been my approach too. Baseball player, you hit singles all year, you're gonna bat 300, right?
Right.
Get on 3 out of 10, baby, going to Hall of Fame.
That's it, dude. So that's kind of been my approach. Just get on base and keep hitting those base hits and try to keep your batting average above 300. So that's kind of been my approach too.
Good.
Love it. All right, I'm gonna swing it over and take it over to what we're gonna dive into today, guys. So when we're all looking at a stock, when we pull up our favorite stock or stock that we have on our watch list, for new investors out there, when you first pull up a chart, it looks like there's just a lot of numbers, right? It looks like you have to look at every single thing, every single moving piece, every single chart and everything, right? But when it comes down to dividend investing, we're not options traders, so we don't have to watch anything as far as moving averages as much. We don't have to watch the yearly or the 5-minute chart. But for value and dividend investing, what are the 3 or 5 things, or what are 3 things that you guys look for when you look at to a company such as Comcast, Avi, Kroger, Spartan, what are some of the things that you guys look at? And whoever wants to go first, or we can all chime in and go.
Go ahead, Paul. You can go first.
I like to see if a company pops up on my radar as a potential dividend investment. The first thing I'm looking at is that payout ratio. How much of their income are they paying out to investors? Are they sending out, you've seen companies that pay out more than 100%. Well, that means they're bringing on debt to keep their investors happy with the dividends, to avoid a cut, to avoid a stock drop. So I like to look at those companies that are paying, under 50% of their dividend, depending on the company. Some REITs, you're going to get more than that. Some energy companies, you may get higher because they pay higher dividends.
MLPs. Yep.
Yeah. But, for your run of the mill companies that are reliant on retail or products to sell or items to things like that, then you want to keep it, definitely under 50. Under 30 would be that sweet spot for me.
Yeah, I agree with that. I agree with that. Is it okay if I speak on payout?
Yeah, this is everybody's talking here.
Okay, cool. Yeah. I'm with Paul. Same thing. That's one of the key metrics that I look at. My sweet spot is usually between 30 and 70%. Just like Paul said, there's always exceptions to the rule. And I put this in my free dividend research guide on Twitter. But payout ratio is definitely an important factor. We see companies that are over 100%, like Paul says, and to me, that's a red flag. I appreciate them trying to cater to the shareholders, but we're investing in the company and they need to cater to the company as well. And
long term,
exactly. And like Paul said, there's always exceptions to the rule. I feel that when I'm looking at a company and there's quality products, quality quality dividend growth and history there, I tend to overlook that 70 and I can even push it up to 80. But
okay.
Just like Paul said, that's a very important metric, and it definitely should be observed when you're looking at a dividend stock.
Yes, definitely agreed. And then when the payout ratio is like, under our threshold, companies do take the rest of that money and what do they pay down? They pay down debt.
Absolutely.
They help grow the company. What are some other things that companies do with with the leftover from after they pay us out? The reason why we want that payout ratio to be low.
Just like you said, they take that money and they can either put it aside for later, or they could instantly try to improve operations. They can pay off their debt. They can use it for multiple things, marketing and advertising and things like that. But just like you said, it's good that some of the companies, they keep some for later, because as they run into problems and as they occur things in the market, they have the funds on hand to make those improvements. So very important.
Exactly. Boom. What's one company that you own that has a good payout ratio for some of our viewers out there?
Come on, man. I'm going with PepsiCo, bro. I gotta go with
PepsiCo. Okay. All right. PepsiCo. I love it. I don't own PepsiCo, but I have it in SCHD. I love the company.
Okay.
I love Coca-Cola too.
Yeah, man, you already know. And I think they're at 58% the last time I checked. So really nice, man. Really nice spot to be in for a company that big,
Yes. Bingo, bango. The next thing, one thing that I look at would be the yield. I know I keep looking. I have my screen right here, but
I'm like, what are you looking at, man?
Yeah, I got to get a camera on my screen, so I'll keep going back and forth. But yeah, one thing I look at too for when we first start out is the yield, because a lot of new investors, they get really big-eyed once they find out what those yields mean, and we're going to go out and try to find stuff that pays 10, 20, 30, or not 30%, but like 9, 10, 11%. My yield threshold is, I'd say 2 to 5%. If I'm like looking at a company and I'm going to go long and try to get, achieve 100 or more shares long term, they have to be in between that 2 to 5% yield. What do you look at the same type of percentages as well?
Yeah. Typically, I'm usually comfortable around the 3 to 5%, just because I hold long term. So I want to get a stock in there that, that's in that comfortable range. Honestly, I'm going to be honest with you, dog. Yield is probably the last metrics that I look at as far as importance. Just me as a long-term dividend investor. And also, I want to make the point that it all depends on what kind of investor you are as well. If you are purely like a dividend growth investor, which is great, you could be a little bit more comfortable with a 1.5, 1.8, 2% yield, because it's going to grow over time. So it really all depends on what your outlook is on your investing. Are you a growth investor? Are you a value investor like I am? Do you mix the two and marry the two together? Are you an income investor? Do you go basically just on income? So are you going for the JEPIs and the QILDs and the, like the covered call ETFs for income? And then, what is your age? What stage of life are you in that's going to drive your investing? So for me, like you said, dude, it's a lot of blue chip companies. It's a lot of, kind of home names, household names. And I typically like to see that 3 to 5% yield.
Okay, awesome. Yeah, man, I do. I went and I looked at Spartan Foods.
Oh, did you?
You talked about it on. I took a look at it.
Right.
I'm trying to build up my like little food, like home, my little grocery store section of the portfolio up. So I've been taking a look at them, and they're solid, man.
You're in Kroger, right?
Kroger, yeah. Yep. I'm in some. I got some Kroger. Kroger's my little baby.
That's your sneaky deal right there, huh?
Oh yeah. Okay.
I see you.
Let's see, and then Paul.
Yo.
We didn't forget about you.
I had to take on the family thing.
No, you're good. You're good. We were diving into yield and just going as far as like an important metric. Nick does like between like 3 and 5%, and I'm more focused on like 2 to 5%, which is basically the same lingo and going down basically, where you are in your investment, journey. If you need more income, the portfolio has to switch up to more QILD, JEPI type of funds. From like a yield perspective.
You know what? I'll actually look for the higher yielding companies. I've got a few in some other portfolios that are really low yields, like Qualcomm and WinA. I've sent you about, but for the most part, for my portfolio, what I'm doing, I follow some people who are more contrarian type investors. They're looking for some deep value companies. So you find these companies that are solid companies, deep value, meaning they're trading well below what they maybe should be trading at, which in turn is going to give you a higher dividend yield because the price of the stock is lower.
Right.
I didn't chase. I mean, this is no dig on the dog, but I didn't chase them down for their monster.
Dog. Come on,
I'm just
dog.
throwing anybody out.
I knew I shouldn't have tweeted about that company, man. But I was like, listen, the people got to know about this. Bro.
So, I mean, I've done it in the past. You know, I kind of started about the same time that Nick started. You know, in the late teens, and my journey through investing came through, you know, buying some crap stocks, man, some just trash that went to nothing, and lost lots of money doing that before finding my path to a more steady, less glamorous dividend investing. So I still have a little bit of that risk nature where I'm willing to take a little bit more risk on some companies that I think are undervalued. They're still solid companies that I think will turn out in the future to be good investments. And in the meantime, collect a dividend that's in the higher ranges, closer to 8, 9, 10%.
Solid. I like it.
Yeah. What's one stock that you own, Paul, that's got a pretty solid yield that you have?
Oh, off the top of my head, I'd have to.
Off the top of the dome.
We gotta go up the top, man. Come on.
I wasn't prepared
off the top.
Gotta go with the top.
So let me go in. My wife's portfolio on M1 has most of the dividend stocks that we've been doing, and right now, I'd have to say, Big Lots.
Big Lots. Okay.
Big Lots.
Okay.
Let me
Big Lots got some good stuff. I don't know if you guys have ever been in the store, but like they have good stuff in there.
The only retail, I'm not a big retail person at all, but there's retail in this portfolio because it's where she goes a lot.
He said a lot.
They're at 6.6% right now, dividend yield. And the stock's trading at $18. It's near its 52-week low, so it goes from 1287 up to 4460. And like I said, she goes there a lot, dude. And I'll be driving home from work and she'll send me a text. Hey, I have an order at Big Lots. Can you go pick this up? Like I've had this route from my job. I have a route that goes from my job to Target to Big Lots to home. And because it's just drive up, pick up the order.
Wow, you hit the whole trifecta.
You
might as well hit Starbucks too.
That's me. That's my morning is an Americano at Starbucks. But
hey, be happy that you have a role, Paul.
She includes me in it, yeah.
There you go. That's what we want.
Heck yeah. Awesome. So the last and maybe final metric that I think that investors should definitely take a look at when they are diving deep, or if this is your first time looking at stock, will be the dividend growth rate or the dividend history.
Absolutely.
Paul, did you want to? I'll pass the baton back over to you to see if we can talk about how important the 5-year growth rate and maybe some dividend history is to a company.
This is a new, for me. I haven't really looked at that in the past. Talking to you with your plan that you used and some other, it kind of came up when there's a gentleman who runs a Discord named Gen X Dividend Investor, and it's a community of people. There's no alerts, there's no go buy this, but it's mainly a lot of people who talk about their dividend stocks, and he's got some spreadsheets that you can use to articulate, different metrics. And
what was the name, Paul? What was the name?
Gen X Dividend Investor.
I think I follow him on.
He's on Twitter. Yeah. He's not hugely active, but he's got a YouTube channel where he does a lot of information on there. But that's where I kind of first started paying attention to Cager and looking at that. As I haven't really implemented it. I don't have a metric that I use it's not something I use to evaluate a dividend stock. But it's something I'm learning about, and Teddie's got his 30 by 30 or whatever he calls his system.
It's called the 10, 11, 12 system 10, 11, out there.
12. So I'm learning about it.
Yes. For any new viewers out there, Nick, have you heard about the 10, 11, 12 system?
Not too familiar.
So I read the book Get Rich with Dividends, and chapter 8 in the book is, what's crazy, guys? this chapter 8 in this book is a very important book in this very important chapter in this book, and then chapter 8 in The Intelligent Investor is possibly the most important chapter.
Oh, that's a great book.
I just put those two and two together when I was looking at them. I was like, oh my God, they're both chapter 8s. But this 10, 11, 12 system is a system that means that in 10 years, you will be yielding 11% and have 12% returns. And the companies that fall within that line have to have at least a starting yield of 3 to 5% and at least a 5-year dividend growth rate of at least 10%. One company that fits that on my list, Comcast. I'm gonna back out.
I know you're a fan. Of Comcast. You're always pushing that.
But based off of the history of what these guys have done with stocks that have met this metric over time, they have performed 10 years, yield 11% and have 12% returns minimum. AbbVie is another company that fits within the metric for us as well, and so does STHD. I'm assuming all 56 of your companies, Nick, probably fill into this. But I just wanted to, that's one of the strategies that I've been looking at when I look at a dividend company.
Yeah, it's funny you say that because all this stuff is in my guide as well. It correlates perfectly to what you're saying. I look for 3 to 5% yields, and as far as history, just me personally, I like to see 10 years. I like to see 10 years of increases. I can bend it a little bit. I can go, 7, 8%, even lower if the company is new. Obviously, if it's a new dividend-paying company, they don't have a lot of history. That's okay with me. As long as they're making their way towards profitability, I'm okay with that. But typically, I like to see 10 years. I mean, I'm a little bit more on the conservative side with my portfolio, to be quite honest. But, that 10-year mark of increases and payouts is really what I look for. Now, as far as percentages, the 5-year growth rate, the CAGR, typically I like to look for 5 to 10%. So, like I said, same thing. It's not set in stone. There's always exceptions to the rule. If it's a newer company, I'll be a little bit more lenient. But typically, the blue chips and the well-established companies that I look at, 5 to 10% over the past 5 years is really the spot that I'm looking at.
Okay. Oh yeah, no. See, and that's awesome to hear. Just because for our viewers out there that we're all on the same boat. We may have different pieces to the puzzle, but we're all carrying an important piece to make everything like a perfect picture to what we're on the journey that we're on for dividend investing. So, that's very awesome, guys, from a metric perspective. So what are some companies that you guys have on your watch list for this week?
Passing the baton, Paul. Go ahead, my man.
I don't. I will admit now publicly that I have added Comcast to.
All right, yeah. My man.
But here's the thing. Here's what Dog doesn't know is it's in my kids' M1 the account that I put it. I sold their Neo.
Wait! Come on! Oh my God! You're gonna do me like this on live, dude?
He's breaking your heart right now, dog.
You just did this to me on the podcast. Text, Paul. Text. I'm just kidding.
Yeah.
No, that's a solid move. That's a solid move. Yeah. I listen, Neo right now, I'm not even gonna get on him, but they'll have their day. Every dog has their day.
I figured they're good. It was up a little bit. There's a little bit of green on it, so I thought, well, let's put this money to work, so those dividends can get some reinvestment going on, because they're that portfolio is set up for 50, 60 years, and I want to see that grow for them.
That's awesome. Really great.
Awesome. So I didn't mean to get too far ahead with with what's on our watch list, but back to the dividend investing, guys. So those are like the 3 main things that we look at when we look at a company, and it doesn't take us long to honestly, guys, to evaluate a company to know if it's a buy or not. You would say, right? You probably look at those 3 things and look at an earnings report, you would say, right after that, and you can easily look those up on Google.
I mean, there is a few other things that I look at, like P ratio and
right.
EPS. I look at EPS as well, just for the profitability of the company. But if you throw in PE ratio and EPS into that mix, that's like the perfect lineup of metrics that I look at, and it's a go every single time. I never purchase anything without looking at all those things.
Once you get your resources down and your the website you're going to use and whatever for this data, it's quick. You can go through a watch list pretty quickly to get your overall yes no your big ones knocked off as far as like yield or growth rate, and then after that you can do some more. You whittle that watch list down to a few. Then you can do some more deep dives. Like Nick was saying, you get to know what's the CEO like, what's the board like, what are their goals, what are they doing with their money. And you can do some more in-depth research before you make
absolutely.
a buy.
I think that's very important. Knowing your investments is extremely important. And then it's just like anything in life. You want to be comfortable with what you're doing. So you want to know that company is making money, or if they're new, you want to know that they're working their way towards making money. And you want to know it's just like when you go to like a restaurant, right? When you go to a restaurant, you want to know that place gives you good food, that gives good service. Same thing when you're looking at a stock to put your money in. You want to make sure that company is solid. Not like Zim, but just things like that. Just joking, dog. Listen,
dog. Dude, that stock is taking my legs from underneath me and just.
Yeah, but they got a lot of money on hand, bro. They're
I have no idea.
So
I have no idea.
I'm not investing in them, but I can totally understand why someone would. I mean,
I kind of wish I didn't.
They're cash flow positive, so that industry, these companies are holding a lot of money, the transportation industry. So, it's going to be interesting to see that company. But just the idea that I was saying is that you want to know your numbers. You want to know, and then honestly, for me, you want to go as far as you can. You want to know about the CEO. You want to learn about where the headquarters is. You want to know how many employees the company has. These are the things that are important to me personally, because, hey, listen, man, I work hard for my money and I have for a long time. I want to put my money in the hands of CEOs that knows what they're doing,
Mm-hmm. Yep, for sure.
That's facts. And then to round this up is we can all find this information when you go to a company's investors relations page, and they'll have a investor basically presentation set up that is like they actually spend money on making this like very easy for us to read. And they put it all together on their like last night I was looking at ET's January 2023's this year. Yep, for their start of this year I was looking at their investor presentation, basically just going over last year's numbers, what they're doing for this year and so on. But this just goes to show that each company, guys, they have this information readily available on the website. Just like if we were to go there to look at a careers page and apply for a job, they have an investors page. We can apply that same type of energy, but this time we'll be applying it to make some cash off of them.
Mm-hmm.
Well, guys, I thank you guys again for joining. Nick, Paul, today's been a great Sunday Fun Day podcast. We're going to round this up, and I just wanted to give a shout out to all of our followers out there for hitting the like and subscribe button. And if you're new out there, don't forget to hit the like and subscribe button as well. And we are out of here, and we got Nick. Nick, go ahead and give a shout out for yourself. You got your Twitter and all your social handle. I think you got like 14,000 followers on Twitter too, Nick.
Yes, sir. Yes, sir. First of all, again, guys, I want to say thank you guys so much for having me on. It's been a delighting experience for me and very humbling. So I really appreciate you guys thinking about me. I hope this talk brings some value to your audience. If anybody's interested in some of my content, I'm on Twitter at SmartNetWorth1. I'm on Instagram at SmartNetWorth. And I just recently dropped a intro to dividend investing ebook. So it's a really great resource for beginners. So if anybody's interested, check all those things out. And again, guys, I really, really appreciate you having me on.
We appreciate your time very much, man. Thank you.
Yes. Thank you again, Nick. And thank you guys, 9 to 5 Nation, the Investing on a 9 to 5 podcast. We are out of here. See ya.